when you decide to basically enter into the market, there would be this rush of, people basically coming in, which basically means that because these interest rate cuts happens slowly and gradually, they don't happen as fast as the interest rate rise has happened, in my own honest opinion. What happens is your serviceability comes in very slowly, but the market starts moving really, really fast because people who can afford to go in, like business owners sitting on a lot of cash, they will jump in and they will buy 2 properties or 3 properties right away. Hello and welcome to Help Me Buy Property podcast. Today we are talking about the lending environment in 2024, what to expect out of interest rates and the credit availability in 2024, the consumer confidence, the interest rate, the rises and the falls. Before we go right deep into the topic, let me introduce my co-host today, Chris from Unconditional Finance. Chris, how are you today?
I'm good, Moss. Thank you for having me on for the first time. So yeah, really excited to discuss all things lending. Obviously, it's a topic on everyone's tongues at the moment. So yeah, excited to sort of get into it today.
And it's interesting dynamics when you talk about lending and how the property markets go hand in hand with credit availability and lending. Now, before we get right into that, a quick shout out to Unconditional Finance. I know we've been working for a while, but give a bit of a brief background about who you are and what you do.
Yeah, absolutely. Yeah. So I always like to say we're a mortgage broking company that specializes working with property investors. I'm a bit of a property nerd. Property investment, finance is really our niche in our specialty. I mean, we do all facets of finance, Moss, but yeah, I sort of created Unconditional Finance 7 years ago. Prior to that, I had 13 years working in the bank in various roles from BD, business development through to credit. And yeah, we really just sort of kicked off. It was me and one VA in the Philippines, and we've sort of grown over the last 7 or 8 years, and now I've got 11 people in my team here in Sydney, and I've got 7 in the Philippines as well. So awesome. Yeah, we're obviously sort of kicking a few goals, and I just find the demand now from consumers for good advice around property investing, how to structure their loans, it's more critical than ever.
Sure. And so in relation to your expert advice, if we talk about lending environment, credit availability in 2024, thinking from a bank policy changes perspective and the expectations, where do you think that the market would be heading?
Yeah, it's bloody tough at the moment. So we won't sugarcoat it. And I've got a lot of newer people, the last 2 or 3 years in my team. And I keep saying to them, it's never been tougher from a lending perspective. However, there are solutions still with most clients. I think, most consumers have read or they felt it themselves. There's been 13 RBA rate rises, I think, since 2022, I should say. And, that's put pressure on clients' borrowing capacities. Most consumers across Australia with those rate rises have lost around 35 to 40% of borrowing power. So we're looking for more solutions, more so than ever. So yeah, where is the lending environment going? I mean, at the moment, the banks are still what we've probably seen over the last 12 months is the narrowing of rates between owner-occupied and investment lending. I don't know if people out there listening today, 12, 18, 24 months ago, there was almost like a 1 to 1.5% margin between those rates. So they've really actually come back down, and the banks are getting a lot more aggressive around sort of sub-80 lending. And that's for investors as well, whether it's principal and interest or interest only. So there's a lot of good deals to be had if you haven't actually had your rates reviewed lately. And where is it heading? Like, I'm quite bullish on the property market and the lending environment, probably back end of this year into 2025. So we're sort of advising all our clients, Moss, you've got a 6-month window, we believe, before the big bad RBA does look to potentially start cutting interest rates. So yeah, just to summarize, I mean, it is harder. But from a broker's perspective, we're using a lot of second, third tier lenders that we've never used before. And we'll sort of, go into that in a little bit more detail shortly.
And it's quite interesting, like when you talk about post-real commission, right? The banking and the policy making has changed quite significantly, right? And so typically what banks have done is, as they've seen interest rate rises coming through, they want to do a lot of due diligence, improve their sort of credit assessment, making sure that they're not putting people under pressure. Because of course people would love to overinvest and make money and dive into the market when the market is so low, right? So It's a very chicken and egg story. Like I always think about this, that while it's great to buy in this market, but you don't have the serviceability to go in and buy a premium product. And so I always was cautioning when the interest rates were cutting off that, you should buy before. You don't wait for that doomsday to happen, because when you are in the doomsday, you are part of that doomsday. And so, you can't move that borrowing at all. Like, especially people who are on PAYG income and not business owners where they can play around with their income, right? So
correct. Yeah.
It's quite interesting.
Yeah, it is. Yeah. So, and I guess the human mentality, like a lot of clients are actually sitting on the sidelines now saying it's too hard, Chris. And part of our job is, I can say you can, borrow $1 million, Moss, but it still needs to work into a family's budget and their affordability as well. But yeah, I think if you've got the means as well, it's a bit of a mental shift as well that, most 100%. People aren't sort of out there buying, looking to take on more debt in the current environment, but you've got to sort of switch your mindset to that professional investor type mindset. So you don't want to be looking back in 6 or 12 months time going, bugger, I should have sort of moved at the start of 2024 because property prices have gone up another 5-10% across the country. So it's definitely been a lot more challenging. There's a lot more work involved per deal. But having said that, it's a lot more rewarding. I think investor-friendly brokers are really coming to the front of the queue in terms of that advice is needed. So it's all about structuring your loans correctly, choosing the right lenders correctly as well, which is going to not inhibit your ability to keep moving forward. So
definitely. And we will talk about investment-focused brokers, and we'll go into a lot more detail about why your broker should be an astute investor, him or herself.
Yep.
But if I take a step back and think about the key signs that brokers are always looking at from a lending environment changes perspective, or, the banks signaling that, they are basically easing on their restrictive credit lending policies, what are those key signs? What are those things that you catch from the banks, in those daily routine emails that you get from the bank? Yeah,
good point. So during the GFC, 10 years ago almost, a lot of banks had restrictions around obviously investment lending and LVRs. So LVR being loan to value ratios. And we saw that a little bit during the COVID period as well, where we've got some banks that just would not lend to investors above 80%. We pretty much had no banks that would lend to investors over 90%. So one of the big changes is we've actually got 3 or 4 lenders now that are playing in the 90 plus lenders mortgage insurance space for investors. So that's one thing. There's an appetite there, traditionally called higher risk lending, to offer a product in that space. As again, I said, sort of the margins between investment and owner occupied lending is really sort of narrowed as well. Different policies. I did a little sort of shout out on our Instagram page the other day. Like we're seeing self-employed now. A lot of lenders are now offering 1 year's financial solutions up to 90% as well. Traditionally, that used to be 2 years as well. So the banks are getting a little bit more aggressive around policy, which I love, and also price. And, where will it sort of end up? I wouldn't be surprised. At the moment, all banks stress test all new and existing lending. They normally have, say, a 3% buffer. So if your rate, Mr. Client, is 6%, they're stress testing you over 9%.
9%,
And I mean, that's sort of an APRA-driven type policy, but it wouldn't surprise me rates start to come back down a little bit early next year. That 3% margin might be narrowed to 2.5% or 2%, which obviously frees up a client's borrowing capacity more. So little things like that. And just quickly, I think different types of lending. So self-managed super fund lending is quite prominent in the market at the moment as well. We're seeing a lot of banks starting to play in that space, get a lot more aggressive in pricing that space as well, mate. So, and
that's a very important point that you make, right? People naturally think and default to their own personal portfolios, whereas you have this super fund sitting on the side. And again, please don't constitute this as financial or legal advice or tax advice. And I need to call out this caveat, but ultimately you have this money sitting there on the side, which is, I call it is a low value risk, right? Because your super is super volatile right now at this stage as well. So, instead of taking undue risks in your own personal property portfolio, you can take it typically in your super, seek your own personal financial advice. But having said that, you have constant contributions going into the super. It's a lot easier for you to get the returns in super and cap it there rather than sacrificing your own lifestyle, especially if your cash flow does not allow you to overinvest.
Yeah, exactly. Yeah. So 2 things there. I mean, a lot of people have what I call almost lazy superannuation. They might be in their mid-30s, early 40s, they've combined, might have 300,000 or 400,000 combined superannuation. It's not performing that great. So that's, I guess banks now are obviously getting a little bit more aggressive, as I mentioned, in pricing, because traditionally self-managed super fund lending, Moss, used to be 2 or 3% margin on traditional residential home loan lending, and it's now almost 0.5% only higher than a normal home loan. So that's one benefit. I guess the other benefit is it doesn't actually affect your personal borrowing capacity. So what you borrow and do in super, and again, you got to get your financial advice, et cetera, but what you borrow in your superannuation fund doesn't affect what you're doing outside of that. So it's a good way to grow your portfolio and not sort of affect each other's strategy.
100%. And I think a lot of our viewers and listeners, I think this is like a golden nugget. If you are growing your property portfolio, think about two portfolios at the same time, or think about you yourself as an individual and your super fund as an individual, and you would have your own servicing and you can basically grow those portfolios parallel. When we are discussing, property investment strategies with people, we basically take that into account and build those portfolios side by side. And you would be surprised as to, from a 10, 15, 20 year sort of target perspective, you do amazingly well, even if you hold like 2 or 3 properties in super, which is quite normal in today's circumstances, right? When 80% LVR is pretty common in SMSF lending, which never used to be the case maybe 5, 10 years ago. Yeah,
and that's another thing. Yeah, traditionally you would have to have, Mr. Client, a 30% deposit. That went to 25%. Now that's 20% at 80% LVRs. We've actually got one lender that can consider up to 90% now in self-managed super funds. So again, the banks are getting a little bit more, and I love this. They're competing on price and they're competing 100%. On policy. They're not competing on, refinance. We can throw the biggest sort of cash incentive to a client to obviously move to them. So yeah, definitely, again, get advice, but playing quite heavily in that space at the moment, self-managed super fund lending.
Okay. And one of the, this is $1 million question, right? And everyone is talking about interest rates and where they are going to be. What do you think, Chris? What are we talking about? So we've talked about serviceability, we have talked about lending and the lending environment. What about interest rates?
Well, if we follow Australia's biggest bank being CBA, I think they're quite aggressive. They're saying there's going to be sort of 6 rate cuts in the next sort of 1 to 1.5 years.
Yes.
So, and I guess for the listeners out there today, every 0.25% rate cut from the Reserve Bank of Australia is about 2.5% more borrowing power that you get.
Yeah.
So, it has a little bit of an impact on what you can do and, how much you can actually borrow from the banks. But I think it's a shot in the arm in terms of what it's going to do to the actual market confidence and the people sitting on the sidelines thinking,
100%.
Could I actually do something? They're all going to come back into the market as well. So yeah, reading all property people like yourself, some economists that I follow, some of the major banks, CBA and Westpac are quite bullish in terms of where the cash rate's actually going. I think we'll definitely get that first. Especially, there's going to be a lot of government pressure as well, Hoss. We've got an election, I think, in March, April, May next year. So what do you think the government's going to be doing to the RBA? They want to look like they're the ones, obviously, hey, we're coming to the party in terms of all this cost of living crisis.
100%.
We're the ones that are, helping that. So I think definitely 1 or 2 potentially at the end of 2024, and then possibly anywhere between 2 and 4 more rate cuts leading into 2025.
And it's also interesting, if you think about the US economy, Australia is almost hedged to US economy. And so when US started raising the rates, in order to, keep your foreign exchange in line, Australia has to almost do exactly the same thing, or you basically drop your, Australian dollars quite significantly. And so while the reverse is happening now in US and they've started cutting their rates, it's almost the same scenario on the opposite side, right? If Australia doesn't drop its interest rate, our currency becomes way too stronger than them. And people remember those days where Australian US dollar were at parity. Amazing time to travel, but worst time to invest, basically, because, a lot of the people were basically thinking about, hey, take this money overseas rather than investing locally. I think one of the most important thing that I think about all the time is these are cyclical nature of events when you talk about property investing, right? And people always tend to think about it from a point in time perspective. Again, you see a lot of people sitting on the edge saying, hey, I'm going to wait for that interest rate cut to happen and then I'm going to jump. What do you think about that?
Yeah. And again, it's a mindset thing. Are you Mr. Client, respectfully, are you going to be investing for 12 months? Or is the goal here to obviously invest over the next 5 or 10 years? So you really want to take a historical approach in terms of looking at interest rates, and the same with property performance as well. Things, there's little bumps along the way as well. So again, we're sort of encouraging our clients, it is still their decision that there is a window here, a window of opportunity before I think the market goes really crazy again. And I guess take that longer term view approach to interest rates. And I guess it is a little bit higher from where they've been over the last 5 or 8 years, but longer term, they're sitting at sort of historical averages at the moment, Moss. So again, sort of look beyond that. It looks like rates are starting to come back down. So don't wait until that happens.
Yeah. And ultimately you're making a decision on a long-term equilibrium, right? So long-term equilibrium interest rate should sit somewhere around 3.5-4% typically, right? So that's where the strategy really plays. Also, one of the things that goes through my head all the time is, and I've seen numerous property cycles typically, is that if you're waiting for that cut to happen, know that you're not alone, and there would be thousands and thousands of people who are thinking exactly like you, right? And so when you decide to basically enter into the market, there would be this rush of people basically coming in, which basically means that because these interest rate cuts happens slowly and gradually, they don't happen as fast as the interest rate rise has happened, in my own honest opinion.
Correct.
What happens is your serviceability comes in very slowly, but the market starts moving really, really fast because people who can afford to go in, like business owners sitting on a lot of cash, they will jump in and they will buy 2 properties or 3 properties right away. And so what you realize is that you could have entered at 400,000 price point or 500,000 price point or 600,000 price point. And by the time you are like, oh, I'm going to now enter, that price point has actually disappeared. And so you're like, oh, okay, I was looking in this particular suburb, this market has come in and gone, it's grown by like $50,000 or $100,000. And I'm looking for now new markets because, my price point is, or my serviceability is not coming back as fast as the market is coming back.
Exactly. Yeah. And again, as I highlighted before, man, every sort of 0.25% rate cut, it's 2.5% borrowing power. So a full 1%, it's 10% more that you can borrow. So it's not a huge amount. Your borrowing capacity is 500,000. You can only borrow an extra, 50,000 on top of that. However, like you highlighted, that property that you were waiting on just want to time the mark, you've missed that. It's grown by more than that. So yeah, just 100%. It's a mindset thing. That's the way you've got to approach it if you're an investor.
Now, one last question that I have for you, and this is an interesting comment, and I was reading somewhere that 47% of Australians have created a household budget in today's time for the first time. And close to like 500,000 of like advisors who are out there doing these budgeting tools and, using the Westpac app and the Commonwealth app and all of these apps to track their spending and see how it's categorized. And none of this was happening before. And it seems that the investors themselves are watching their cost of living and, and eager to see as to how can they make that saving to basically tap into the market, because they know that this affordability that is out there is disappearing so fast, right?
Correct. Yeah.
And so it's interesting to note. Are you seeing some of those trends coming through your clients as well, where the client is getting a lot more astute and they're like, hey, I've saved an extra. I couldn't have saved this before, but I know I can now.
Correct. Yeah. I guess the family budget, it's being looked at a lot closer as well. And there's things that we do as well. Like our role, yes, we're an investor-friendly broker, but, we've got other strategies in place to try and pay off your owner-occupied debt a lot quicker. How can we restructure your loans, like your lazy debt, your car loans, your credit cards, your HEX debts, to actually improve your household cash flow, and importantly, obviously increase your borrowing power as well. So clients are getting a lot more educated around that, and we're spending a lot more time as brokers sort of educating clients on that and, ways to improve, I should say, the family budget. So
definitely. Any last words, Chris, before we wrap up the episode?
I don't think so. So again, just want to highlight, to me, you have a Mr. and Mrs. Client. You've got a good 6-month window here before our friends at the RBA look to potentially cut interest rates. And I say this, even some of my close friends, they're sitting on the sidelines and they know I'm in the game, and yet all the encouragement in the world, they're just a little bit, I'm not sure if now's the time, but don't be looking back in 12 months' time going a bit like COVID, going, sugar, I actually missed the boat again. So yeah, if you're not sure where you stand, I mean, obviously speak to people like you, Moss, reach out to us. It's a free consultation for 15 minutes.
100%.
You can quickly review where you sit and, have that investor mind. There's no better time to invest than today.
Thank you. I think these are golden words. Understand, as from a user's perspective, a normal investor right now is allocating 47% of their income to service a new loan in today's time. That number would drop quite significantly as soon as the interest rate starts coming down. And so the more disposable income that you have on your hand, together with the tax rate cuts we'll talk about in the next episode, is going to do something magical in the property investment space. So watch this space, be kind, stay safe, keep smiling, keep investing. This is Moss and Chris checking out. Adios.
Thanks, Moss. Cheers.